With the avoidance of doubt, the Simple Side does not provide investment, tax, or legal advice. As with any asset, the value of any asset class can go up or down, and there can be substantial risk that you lose your money buying, selling, holding, or investing in any asset. You should carefully consider whether trading or holding assets is suitable for you in light of your financial condition.
All right, it has been about 3 months since we put our portfolios on autopilot so that you could track and copy all of our trades. And since then, our portfolios are up 29%, 21%, and 7%. Let's talk about what's driving that all today.
Welcome to the simple side. Market beating picks inside. There's no jargon and no time to waste. Join the simple side and end up in first place.
All right, everybody, welcome back to the Saturday Sendout from the Simple Side. Like I said, our portfolios are up 29%, 21%, and 7% over the past 3 months. Incredible performance there. We'll talk a little bit later about the year-to-date performance on all those portfolios, but over the past 3 months, incredible outperformance. Very happy with all of that. As always, I've got some quick reminders for you. Our full disclosure is in our email footer. Portfolio copy trading is available by clicking the link in the newsletter, thesimpleside.substack.com. That'll take you to Autopilot, where you can copy trade our portfolios. You can also find our podcast on YouTube, Spotify, or Apple Music, and of course, anywhere else that podcasts get sent out, including here on Substack. And you can get daily market news from our daily newsletter, The Simple Side Daily, which you can find at thesimpleSideDaily.substack.com. As always, there's a button in the newsletter that you can click that will leave me your comments about what you want to see added, what you want to see removed, anything that you wish was in the newsletter, anything that you want to be taken out of the newsletter. And if you fill that out, it'll let me continue to improve over time. Now, real quick, we do every single week show you our overextended and oversold positions. These, of course, are the top and bottom 3 positions that we hold in each of our 3 individual portfolios that we run. Right now, our top performing asset in the flagship fund for this year is Google, up 49%. For the AI secondhand effects portfolio, it is Centrus Energy, which is up 413%, followed closely by Bloom Energy, up 353%. And then we've got ticker FLR up 104% on the year. Then in our tech growth portfolio, we've got Oklo up 124%, Hood up 40%, and SoFi up 38%. In our portfolio low section, we've got FTNT down 14% in the flagship fund. In the AI portfolio, we've got EQIX down 13%. And then in the tech growth portfolio, we've got Root down 15%. So those are all positions worth looking at adding to on the low end, and positions that might be worth trimming on the high end, especially when you get to those 413, 353% returns in Centrus Energy and Bloom Energy. Just crazy stuff there. As always, though, we're going to talk about all of the news that happened this past week, and then I'm going to give you some comments on what it means going forward, kind of some forward-looking commentary, just about everything that I'm reporting on. I try to stay as neutral as possible in all the reporting, so I'm not any bullish or bearish on anything. It's just, this is what happened. And then I give my comments on whether I think that's bullish or bearish news in all of the sections that have that purple thing on the left side of the newsletter. So returns this week, what brought them to you? Well, calmer rates brought them, resilient earnings, and of course, a bunch of headline-grabbing corporate moves kept risk appetite alive. Overall, we did see stocks finish higher. The S&P 500 and the Dow both notched weekly gains of around 1.5%. The Nasdaq did dip a bit, but we did see small caps pop midweek, and they ended up cooling a little bit by the end of the week, but overall performed well. The 10-year Treasury yield hugged the 4% line and even dipped below it a few times this week. Now, I want to call out why that Treasury yield being at that 4% and dipping below matters so much right now. This tends to support higher equity valuations, especially when you're looking at growth in tech, I guess, sectors or funds or stocks, whatever you want to call them. Now, this is something that many dumb money investors do not understand right now that are in the markets. Of course, if you want to read up on what dumb money is, go and search that newsletter on my website, thesimpleside.substack.com. But basically, there's almost always an inverse relationship between these two metrics. And when I say these two metrics, I'm talking about small cap stocks and the 10-year Treasury. So in the newsletter, I've got a graph that you can go and look at, and it's showing you from 2023 to now in 2025, the 10-year Treasury yield rate. And then I'm also looking at the Dow Small Cap Index. And what you'll notice is that when rates climb, small caps fall, and when rates fall, small caps rise. And now that's not always the trend. There are times where the trend is bucked, but the majority of the time when you see a large run up in rates or a large run down in rates, you see the exact opposite happening with small cap stocks. And this is the same reason why so many people seem to be so good at investing right now. That's why everybody's portfolios are doing so well. And it's because rates have basically been coming down since late 2023. Of course, there's been ups and downs if you look at the graph, but since late 2023, rates have generally been on the downtrend, which means that small caps have generally been on the uptrend. Again, why everybody's portfolios are doing so well. Now, this effect is exacerbated for small cap stocks because they're more widely affected by the amount of money that their money can make, and they don't get the benefit of having incredible cash flow to finance operations, and a lot more of it comes from borrowing. So the better they can borrow, the more money they're going to make, et cetera, et cetera, et cetera. And that doesn't matter as much for Microsoft, who's spitting off, billions of dollars in cash, and they don't need to borrow as much to be able to run operations. Regardless, rates are going to matter a lot for our AI secondhand effects portfolio and our tech growth portfolio because they hold a lot of these smaller cap companies in it. And these same rates are what are going to drive stocks up or down, especially now. So watching inflation is going to matter a ton when it comes to these small caps in your portfolio. If we start to see inflation run wild, well, small caps are probably going to get hit pretty darn hard. So just something to be aware of, something worth paying attention to and watching out for. Of course, I don't base my investment strategy on macro trends. I try to just find good companies and invest in them for the long run. So I'm not super worried about it, but I can at least explain to you, if you're investing in the stocks that I am, why there's so much volatility in them or why they're going down or why they're going up. And a lot of times it's just because rates or inflation are causing that trend. And a lot of that, of course, right now is so volatile because people think that we're in a bubble. So every move back and forth is kind of exacerbated. Back into the news, oil spent the week around the high 50s, low 60s a barrel, which is relatively low for the current cycle that we're in. Of course, this is going to ease costs for transportation, manufacturing, and consumers. Although it is a headwind for energy producers, of course, companies that are building a product that costs less are going to make less. But it's great for the margins for everybody else. Gold, of course, is hovering near an extraordinarily high $4,100 to $4,300 level. Elevated gold typically signals that investors are buying insurance policies against surprises or geopolitical risk. If you look at China, there seems to be a huge stockpile of gold there as well. Same thing with Russia. And that could be related to BRICS and the potential BRICS currency that we might see. So that might be one of the reasons why gold has been running up so high. But we really have no way of calling that as a surefire bet, but it's something worth thinking about. Of course, we saw a 3% sell-off this week, which is relatively small when you compare it to the 54% returns or the 54% rally that gold has had this year. At the same time, we did see volatility cooling. The VIX slid back into the high teens, which is typically a sign that the market's fear level is easing after the early October wobbles. So all good news on that front. We did see Bitcoin hold near the $110,000 area, and we'll talk a bit more about why that mattered down below. General Motors beat and raised guidance, showing that core auto profits can hold up even as the EV transition zigzags. GE Aerospace lifted its outlook again on strong jet engine demand tied to robust global travel and aircraft production. Shout out to Boeing, of course, for a ton of the work that they've been doing. partnering with a lot of different places and selling a lot of jets, especially overseas. Honeywell, Las Vegas Sands, and several chip-exposed names posted solid reports as well, which is helping the AI rush, if you will, which includes some of the industrials and, of course, a tech lead on all that. Defensive pockets like consumer staples and utilities lagged, which is classic price action when investors are leaning into growth and cyclicals. One thing that I want to mention here is that it is important to remember who the buyers are when it comes to defensives blowing up or decreasing in value. Now, right now, what I've been seeing is retail is the group of people that are selling defense and buying growth. So they're the people that are selling out of Coca-Cola and Pepsi and healthcare stocks like UNH, CNC, Molina Healthcare, all that stuff. And on the flip side, we're seeing a lot of institutional money flowing into those defensives. So obviously when there's retail selling, there has to be a buyer somewhere. And a lot of that right now seems to be institutional, which shows me that there's a switch from the growth phase into the defensive phase, at least in a small portion of all the institutional money that's out there, which is somewhat of a clear signal that big money's positioning itself for a market drop, but it doesn't particularly mean the market's going to drop now or in a few months or in a year. It just means that they're positioning themselves for that to happen. So they're kind of going risk off, but keeping their money in the sphere of equities, which means that they're not super afraid that the market is going to come down. Now, tracking retail versus institutional volume is actually relatively hard, but it is somewhat doable, and there's two ways that you can do it. Robinhood and a lot of other platforms will offer like their platform volume. So Robinhood will offer looks into their investors' volume and whether they're majority buying or majority selling. So that's one way to do it. And then the other way to do it is look at the moves of stocks pre and post market, which to me have been getting bigger and bigger over the past weeks in defensives, which means there's a lot of institutional money flowing into those companies. Now, there are other ways too to go and look at this stuff, but those are just two ways in general that you can kind of watch and pay attention to what's happening with institutional versus retail money. Tech, of course, stayed in the headlines for both good and cautionary reasons. Apple shares were helped by strong iPhone data and news that it's shipping AI servers from a new Texas facility. NVIDIA, and semi equipment names drew support from ongoing AI data center spending. But on the flip side, we saw an AWS outage that reminded everybody how concentrated the internet's plumbing has become. America runs on Duncan, and the internet runs on AWS. It's clear when a major cloud region stumbles, downstream apps from trading to ride-hailing all feel it. The takeaway isn't avoid the cloud. It's just that reliability, multi-cloud setups, and redundancy remain investment priorities for enterprises. And that brings up a great point. I think there's going to be a lot of investment opportunities that arise from this recent issue. A lot of companies are probably going to start looking at data backup solutions or places that they can kind of have cloud safety, if you will. Of course, one of those big bets could be betting on Amazon. You just saw how many companies rely on Amazon and Amazon Web Services. And so there's a great chance that other investors are going to see how reliant everybody is on AWS and then realize that Amazon might be undervalued as a company. So, of course, that's one option. The other place to be looking for potential buys is in cloud backup and data protection companies. RBRK and CLVT are both tickers to go and look at when it comes to all that stuff. We might be including them in some write-ups here in the near future. We talked a little bit about autos before. There's some more information about that in the newsletter. So I'm going to skip over that, but I do want to talk about the deal and capital headlines that kind of cut across some of the sectors recently in the news. Kering sold its beauty unit to L'Oreal to refocus on fashion and shore up their balance sheet. JP Morgan prepared to accept Bitcoin and Ether as collateral for institutional loans. And I feel like this news isn't being treated with enough respect, or it's not being looked at as a big deal, but it really is. I mean, this is basically like one of the biggest banks in the US, in the world, saying that they think that they're willing to accept Bitcoin or Ether in collateral for loans that they're giving out, meaning that they think it has a store value that's going to be long lasting and stable. I mean, we're talking 20, 30 years type stuff. And so that could bode extremely well for the price of Bitcoin and Ether in the short term and in the long term. So it might be worth looking at adding a little bit of money into those assets if that's something that you do. In other crypto news, Coinbase kept expanding with another acquisition. Data landlords such as Digital Realty raised guidance thanks to AI-driven bookings. Of course, DLR, or Digital Realty, is a company that we have in our AI secondhand effects portfolio. So we're happy to see them doing well. Pipeline giant Kinder Morgan outlined a large slate of gas projects tied to LNG exports and the power-hungry AI build-out. Again, this is a big deal. There's something called cogeneration, basically using natural gas and other means to produce energy, and I don't think it's being utilized fully yet. But between the time that we can build a bunch of nuclear plants to power all the AI stuff, there has to be something to kind of hold us over. And it seems like LNG, natural gas, is going to be the thing that gets us there. And Kinder Morgan could benefit in a massive, massive way from this push. And so they're trading at a PE of 21, which seems to be fairly valued. And they could potentially be a massive player in the world of powering AI, which might mean they might be a great investment here in the future. And so we'll kind of be watching them and potentially making a write-up on that stock here in the coming weeks or months. So anyway, I spewed a lot at you here. So let's just do a quick summary of everything that I just put together. So we have steady to softer yields, which are a tailwind for stocks. We've got cheaper oil, which is cooling inflation, which is helping most sectors' costs and helping to keep rates coming down, again, boosting stocks. We've also got high gold, which says that not everybody feels safe, that oil coming down, inflation coming down, rates coming down is the best benefit for the markets right now. And we see a calmer VIX, which means pullbacks are shorter and a bit more orderly, but there's still a big chance that a surprise can hit and kind of drive everything a little bit nutty, if you will. So it's something worth paying attention to and looking at. So if you put all that together, this week, you get a risk-on with hedges approach to the market, powered by earnings doing well, underpinned by the idea that further rate cuts are on the way. Overall, I remain skeptical generally and happy with the large amounts of cash that we currently have on hand and are happy to invest it in the future as we find better ideas. But right now, we like where we're at. Now, I'm not going to do this in the podcast, but you should go jump over to the newsletter where we talk about and track insider trades that have happened because we've been tracking them now for about 2 months. The average return, current return, so from the time that they publish the results that we put them in our Excel sheet to now, the average return on these stocks is 9.55%, and that's, of course, just in a 2-month period. The average weekly return that we're seeing is 10%. The average monthly return that we're seeing is 6.53%, and the average 2-month return that we're seeing is 13.78%. So there's very clearly some reasons to be paying attention to insider buys and potentially making some investments off of all that stuff. So again, not going to talk about it in the podcast, but worth looking at in the newsletter. Okay, now I've got something kind of exciting and fun that we're going to be starting before 2026, going into 2026, throughout the entirety of 2026. And that's that I've had a lot of people emailing me and reaching out and asking that I write more research articles on the state of the economy and research articles on stocks. Now, I'm not a macro analyst, and I've previously stated that I prefer writing about the stocks that I own and producing research only on stocks that I buy. But I think this approach is going to be a bit better for everybody who's subscribing to the newsletter. I've written this before. It's just that writing a newsletter where we invest in companies at the beginning of the year or we don't make very many changes to our portfolios, we kind of let them ride. It's not ideal. A lot of people think that that means that I'm not doing a good job because I'm not sending out a bunch of stocks every week that I think are going to be doing well or whatever. The reality is that we're returning over 300% over the past 3-4 years now in total, obviously not all at the same time. 300% returns since 2020 through 2024. but people want to see more about stocks. I think they want more ideas, and they don't want to know exactly that I'm the one investing in it, but they want to know just about stocks in general. They kind of want to get some updates. They want to be informed. And so I think I'm going to start providing more research for everybody. I don't want to be stock picky, but I have the portfolios. You can track the portfolios. You can buy the portfolios. And I think that providing a bit more research on stocks and the state of the economy is going to be very beneficial for everybody that subscribes. And so I'm not sure exactly how we're going to do this, how we're going to report on it, how it's going to look, but it is going to start happening very soon. I'm going to continue to write the Berkshire buy articles. And I hope that this all becomes beneficial for you guys, just as when it comes to researching stocks, understanding stocks, looking at new potential buys for your portfolios. And so, of course, you'll always have my personal portfolios to go and invest in autopilot, but I'm going to be adding a bunch of research now to the offerings that we have as well. Now, I mentioned the Berkshire buy articles, and right now, the average return per article for those is 18.81%. The lowest return that we're seeing is negative 7.42% on a company that in the article I said, don't buy. It fits Buffett's criteria, but I wouldn't buy this. It's a home builder. And the top return is 67.83%, which is Napco Security Technologies, ticker NSSC. The one below that's 61%. The next one's 25%. So vast outperformance to underperformance ratio on all those companies. Very happy with the performance that we've seen there, and I'll be writing more of those in the weeks and months to come. Now, of course, the portfolios that you guys all have access to on autopilot, the AI Secondhand Effects portfolio up 29%, Tech Focused Growth up 21%, the flagship fund up 7%. We're very happy with these returns. If you're a paying subscriber, you can scroll down and look at all the current holdings, look at all the returns over the past week, and get some commentary from me about the stocks in the portfolios, how I'm looking at changing the portfolios in the coming weeks, stocks that I'm looking at taking out because we're kind of overextended them or their movements are affecting the portfolios a bit too much. As always, I'll be seeing you next week. Hopefully between now and then, you'll get some cool research articles sent to you. And maybe some new sheets added to the Google Sheet that track all the research articles and all that stuff. So we'll get something put together and share with you guys. But until then, continue paying attention to the markets, continue watching the newsletter closely, and I will see you next week.